The global silver market did not collapse overnight. It cracked silently, layer by layer, while most investors were distracted by noise, headlines, and artificial price stability. For decades, silver was treated as abundant, replaceable, and boring, quietly powering the modern world without demanding attention or respect from markets. But beneath that calm surface, stress accumulated as industrial demand grew faster than supply, and inventories were slowly drained to maintain the illusion of balance. The warning signs were always there, hidden in delivery delays, rising premiums, and unexplained discrepancies between paper prices and physical availability. This story is not about speculation. It is about physics, manufacturing reality, and a system stretched far beyond its limits. Silver is not a luxury metal. It is an industrial necessity embedded in nearly every advanced technology. Solar panels, electric vehicles, semiconductors, data centers, and military systems all rely on silver's unmatched conductivity. Remove silver and the modern economy does not slow down, it stops. Yet pricing mechanisms continue to treat silver like a financial toy rather than a strategic input. That contradiction set the stage for the crisis now unfolding. The first cracks appeared when industrial buyers quietly increased long-term contracts, bypassing spot markets entirely. These were not investors chasing upside. They were manufacturers securing survival. At the same time, mining supply stagnated, constrained by geology, regulation, and years of underinvestment. New mines could not appear on demand. The pipeline was already broken. The system survived only because above-ground inventories filled the gap. Those inventories were never as large as reported. Much of the silver was leased, rehypothecated, and promised to multiple parties simultaneously. Confidence, not metal, became the foundation of pricing. As long as nobody asked for delivery, the system held. That assumption was about to fail. What most investors still don't realize is that Musk's warning wasn't abstract. It was tied to a specific event with a fixed date. In less than days, the single largest structural disruption to the silver supply chain officially goes into effect. On January 1st, China activates a new silver export licensing regime that permanently changes global access to refined metal. This is not paperwork. This is resource control disguised as regulation, designed to redirect silver inward and starve external buyers. China is the world's largest processor and refiner of silver, controlling the critical middle of the supply chain. Even silver mined in Mexico or Peru often passes through Chinese refineries before reaching global markets. When China tightens exports, it doesn't matter where the ore comes from. The bottleneck decides who receives metal. The new licensing rules instantly eliminate hundreds of smaller exporters from the global silver trade. Only firms with massive production capacity and deep credit lines qualify, concentrating exports into state-aligned giants. Everyone else is locked out. Their silver stays inside China, feeding domestic manufacturers instead of global supply. This is not market behavior. This is strategic resource nationalism executed with surgical precision. China is prioritizing its EV manufacturers, solar giants, and electronics producers at the expense of Western industry. It is the same playbook used with rare earths: restrict exports, dominate manufacturing, force dependency. The difference is scale. Silver touches nearly every advanced technology powering the modern economy. Once exports tighten, global price discovery fractures. There is no longer one silver price, there are two. Inside China, metal remains available at controlled prices. Outside China, scarcity begins to dictate terms. Arbitrage dies the moment metal cannot move freely between markets. Western traders can no longer buy cheap silver abroad to relieve domestic shortages. This forces all Western industrial demand into already depleted New York and London vaults. And that pressure transforms a manageable deficit into a cascading supply crisis. For years, the silver market survived on one illusion: that shortages were temporary and supply would eventually catch up. That illusion collapses once you understand the math behind global silver production versus real industrial consumption. Silver mining output has been flat for over a decade, while industrial demand quietly accelerates every single year. Unlike oil, silver cannot be ramped up quickly. New mines take 10 to 15 years to come online. Most silver isn't mined directly. It's a byproduct of copper, zinc, and lead extraction. That means silver supply depends on decisions made for completely different metals, not silver demand itself. When copper production slows, silver disappears with it, regardless of how badly the world needs the metal. Meanwhile, solar panels, EVs, data centers, and military electronics consume silver permanently. Unlike jewelry or coins, industrial silver is destroyed, dispersed, or locked inside complex products. Recycling sounds promising, but recovery rates remain painfully low and economically inefficient at scale. Once silver enters a circuit board or solar cell, it is effectively gone from the market forever. This creates a structural deficit, where annual demand consistently exceeds annual new supply. The gap is quietly filled by above-ground inventories accumulated decades ago. Those inventories are not infinite, and they are shrinking far faster than public reports admit. Vaults in London and New York show stability only because metal is leased, swapped, and rehypothecated. The same ounce is promised to multiple owners, assuming not everyone asks for delivery at once. This system works only in calm markets, where confidence replaces physical verification. But confidence evaporates the moment supply disruptions turn theoretical shortages into real ones. China's export controls turn a slow structural deficit into an accelerating physical drain. At this point, silver stops behaving like a commodity and starts behaving like a strategic asset. Industrial buyers are not watching silver charts. They are watching inventories, delivery schedules, and factory shutdown timelines. When inventories fall below safety thresholds, price becomes secondary to physical availability. A solar manufacturer missing silver deliveries does not lose profit margin. It loses entire quarters of production. Electric vehicle factories cannot substitute silver without redesigning systems, certifications, and supply chains. In critical manufacturing, silver demand is price inelastic. Even doubled prices do not reduce consumption. This is where traditional commodity models completely break down. Rising prices no longer balance supply and demand. They amplify fear. Procurement managers begin locking long-term contracts at any price, just to guarantee delivery. Smaller buyers are pushed out first, unable to compete with global giants bidding aggressively for metal. The silver market begins to resemble a war zone, not a marketplace. Spot prices detach from physical premiums, creating confusion across trading desks worldwide. Futures contracts claim abundance, while warehouses quietly report tightening availability. This divergence signals a market under stress, approaching structural failure. Some buyers stop asking for quotes and start demanding delivery, regardless of contractual penalties. Every physical withdrawal exposes how little unencumbered silver actually exists. Dealers delay shipments, renegotiate terms, and ration supply behind closed doors. Rumors spread faster than official reports, intensifying fear across the supply chain. Once panic buying begins, it feeds on itself and becomes impossible to reverse. The system shifts from optimization to survival. At this stage, silver pricing stops reflecting value and starts reflecting desperation. As physical demand explodes, attention turns toward the paper markets that supposedly anchor global silver pricing. COMEX and LBMA are designed for liquidity, not mass physical delivery under stress conditions. For decades, futures contracts rolled quietly, with only a tiny fraction ever requesting metal. That assumption fails when industrial buyers and funds demand real ounces, not cash settlement. Warehouse inventories appear stable, but most metal is already spoken for multiple times. Registered silver shrinks rapidly as delivery requests spike beyond historical norms. Each delivery drains confidence faster than it drains metal. Clearing members quietly encourage cash settlement, signaling growing strain behind the scenes. This is the first visible crack between paper promises and physical reality. Short sellers discover there is no easy exit when metal cannot be sourced. Buyers refuse paper offsets and insist on shipment, escalating pressure on exchange mechanisms. Margins are raised, not to stabilize markets, but to slow demand and buy time. Instead of calming traders, higher margins confirm something is seriously wrong. Price volatility explodes as liquidity evaporates across futures markets. Bid-ask spreads widen, reflecting fear rather than valuation. Rumors of delayed deliveries circulate, then quietly become standard procedure. Every settlement without metal further erodes trust in the pricing system. The market begins searching for alternative pricing mechanisms outside traditional exchanges. Once price discovery leaves COMEX, control over silver pricing is effectively lost. This is the moment when paper silver stops functioning as money. Short sellers built positions assuming liquidity would always exist, metal would always appear, and confidence would always hold. They never planned for a market where silver simply cannot be sourced at any reasonable price. As delivery demands surge, shorts are forced to compete directly with industrial buyers for physical metal. This is a fight they cannot win. Industrial buyers do not speculate. They buy to survive, and they buy regardless of price. Each failed attempt to locate silver forces shorts to bid higher, accelerating upward price momentum. What began as volatility quickly transforms into a classic supply-driven short squeeze. Margin calls ripple through hedge funds, trading desks, and commodity portfolios worldwide. Positions that looked safe for years suddenly become existential threats overnight. Forced liquidations push prices higher, triggering even more margin calls in a self-reinforcing loop. This feedback loop is mechanical, emotionless, and brutally efficient. Attempts to cap price movements fail, as physical premiums detach completely from futures pricing. Dealers quote availability first, price second, if they quote at all. Retail investors notice something is wrong when coins and bars vanish from shelves worldwide. Premiums explode, sometimes doubling the published spot price. At this stage, spot price becomes a reference, not a transaction reality. The silver market fragments into isolated pools with wildly different pricing. No arbitrage can close the gap because metal cannot move fast enough. Every attempt to suppress price only confirms the depth of the shortage. This is the ignition point of silver's historic repricing. Once short squeezes exhaust paper leverage, markets enter a different phase entirely, repricing based on physical reality. This is not speculation. This is recalibration of silver's role inside the global economic system. Historically, silver was treated as abundant, secondary, and easily replaceable. That assumption died when inventories vanish and substitution proves impossible. Manufacturers now price silver as a strategic input, not a cost to be minimized. Long-term contracts reset at multiples of previous prices, locking scarcity into future supply curves. Governments begin monitoring silver flows alongside energy, food, and rare earth materials. Some quietly classify silver as a critical national resource. Export controls expand beyond China as other producing nations reassess their own vulnerabilities. This accelerates fragmentation of the global silver market into protected regional zones. The concept of a single global silver price becomes obsolete. Instead, pricing reflects geopolitical access, strategic alliances, and industrial priority. Western economies realize decades of offshoring created hidden dependencies they can no longer ignore. Reshoring manufacturing increases silver demand precisely when supply flexibility is lowest. This creates a feedback loop between industrial policy and commodity scarcity. Historical comparisons emerge, but none fully apply. Unlike the 1970s, silver is now embedded inside advanced technologies powering civilization itself. Unlike rare earth crises, silver demand spans civilian, military, and energy infrastructure simultaneously. There is no quick fix, no emergency mine, no technological escape hatch. The repricing is not a spike, it is a structural reset. When the dust finally settles, the world does not return to the old silver market. That market no longer exists. Silver has crossed a threshold, from traded commodity to strategic constraint embedded in global power structures. Prices stabilize, not because supply improves, but because demand learns the cost of scarcity. Manufacturers adapt by redesigning products, but silver intensity declines slowly, measured in decades, not quarters. Governments establish strategic silver reserves, competing directly with private industry for limited supply. What was once invisible inside supply chains becomes politically visible and fiercely contested. Nations with refining capacity and domestic silver access gain disproportionate economic leverage. Those without access pay a permanent premium to participate in advanced technological production. Investment flows shift from speculation toward security, stockpiles, and long-term physical control. Silver ownership stops being about upside and starts being about access. Retail investors realize too late that paper exposure no longer guarantees physical availability. Coins, bars, and industrial contracts exist in separate worlds with separate pricing realities. The lesson echoes across markets. Abundance was an illusion created by trust, not supply. When trust breaks, physical reality asserts itself with ruthless efficiency. Silver's repricing is not a bubble, not a mania, and not a temporary disruption. It is the consequence of decades of underinvestment, overconsumption, and misplaced confidence. The future economy runs on electrons, data, and energy, and silver quietly sits at the center of all three. This war was never about money alone. It was about who controls the building blocks of modern civilization. By the time the headlines catch up, the positioning phase is already over. Those who understood early secured access. Those who waited paid whatever price was demanded. Markets will debate numbers, targets, and forecasts. History will remember something simpler. Silver was underestimated until it was. And when the world finally noticed, there was no way back. This is not the end of the silver story. This is the beginning of a new industrial order.